All right, everybody, welcome to a very special episode here on the VIP Financial Ed channel. If you're not yet a subscriber, consider subscribing. I've got Chris Donnelly with me here on this episode. Chris is a viewer like yourselves. We are now offering complimentary coaching sessions. Once again, check the description below if you're interested in getting a coaching session yourself. We're going to spend a little time with Chris addressing some of his both short and longer term objectives and apply some of the most popular techniques that people come to this channel to get. Full disclaimer, I have not seen this cash flow cruncher before, so Chris and I are coming in blind on this conversation. This would be as if I was having any other phone call with a viewer. So this will be a similar experience for any of you guys that decide to sign up for a coaching session like this for yourself. So, all right, Chris, the first thing I'm going to do when I open up a cash flow cruncher spreadsheet, which this is your most recent here, obviously, I like to jump right to this cash flow summary page. And for those of you guys that haven't yet downloaded one of these, you can go to cashflowcruncher.com to pull down a version, and it operates through Excel or through Numbers or even an open office source that you can get through here online too if you don't have Microsoft. But this is an Excel spreadsheet. You've got various pages down below. Each one of these pages gets filled in. If you haven't kept close tabs on your numbers, this exercise the first time can easily take upwards of an hour. If you're really disorganized, maybe slightly longer. Maintaining it on a monthly basis and keeping an updated version for each month, which is what I recommend doing, is typically something you can do within 30 minutes or less. So very simple to put in the information between revenue and assets, your debts page, your personal expenses, there's a business expenses page. I would recommend, if you are operating businesses that have their unique financial ecosystems, income, expenses, cash flow, in some cases, maybe even your borrowing and there are debts, I would create a separate cash flow cruncher for each financial ecosystem. For each business I own, I have my own cash flow cruncher for it. Then you would have one for the personal household, and any income you're paying for yourself would be marked as obviously an expense or a distribution on your business, and it would be noted here in the revenue section as one of your income streams on your personal household cash flow cruncher. So that'll keep things much more streamlined for those of you that have multiple financial ecosystems. Now, in your case here, just getting back to this summary tab, which sort of imports all the data. This is, and as you can see right here, a non-editable page. So I do get people who email in saying, I can't change any of these fields. It needs a password. It does not need a password to operate this cash flow cruncher. And like I said, totally free, no strings attached to get access to this and use it for yourself on a month-to-month basis. It'll import all the information that you put in on this side. So for instance, if I were to change this from a $7,000 a month total revenue to an $8,000, the cash flow has increased by $1,000 here. So I'll change this back to the 7. And let's just kind of pull out some of the key indicators here. We've got a total revenue of $11,000. This is normally where I'm going to start when I get a cruncher spreadsheet, is look at this summary page and just get as much information from this as I can. I see that we've got a $274,000 current balance on our mortgage with roughly $409,000 in total debts, which tells me that with some rough math, somewhere about $135,000 is non-mortgage related balances, which are demonstrated here. We'll get into that on the debts page to get a little more specific. We see the difference between our net cash flow position, which is the amount of money that's left over at the end of each month, which should either be getting tucked away in some form of a bank account now, or it's being invested, which would also be put on the separate pages for investments back on personal expenses. Thereby, it would still be calculating your cash flow differently, or you're cashing it, tucking it into a sock drawer. This money should be left around. This should come out to be as close to accurate as possible. While you're putting the detail inside the cruncher, I always recommend using conservatively realistic numbers. And the first time you fill it out, you're generally going to want to go off of averages. Use a 12 or 24 month collection of income and expenses. For 100% of people, expenses vary. You're not going to pay automobile registration every month, for instance. For those of us who are self-employed or who have various income through other outside sources, oftentimes our income even varies from one month to the next, which is why averages are very important to be using on that first spreadsheet. Moving forward, you would save this. You can see that Chris has actually titled this November 1st, 2022. That's perfectly done. You would save a folder inside your computer, either on your desktop or elsewhere, that says VIP Cash Flow Crunchers, and going into November, obviously, he would change this to his Decembers, and you'll have a chronological history of your cash flow crunchers, and you would just update it according to that exact month's information. So it seems like you're doing this accurately. Tell me a little bit about this net cash flow. Does this number feel correct to you? $4,382 a month?
It's pretty close, based on my business expenses of about my extra business, my side hustle. It brings me about $50,000 a year, but I divided that by 12, came out with $4,000 a month. That's so some months maybe zero, some months maybe $10,000. It flows all out at the end. So
Okay.
it doesn't represent exactly the same, but to make the months. But I
Right.
do realize that, listening to you, I should probably separate out my business in a different cash flow cruncher.
That would be my recommendation. Absolutely. Definitely get a second one going. Let's go ahead and just mosey our way into these other pages. And the only other thing that catches my attention here is the difference between the gross cash flow, which, as you can see through this description, this number represents your average cash flow at the end of each month once you no longer have any debt. And we highlight this as our goal. Now, this is not a one-size-fits-all solution. There are times where not attacking certain debts for various reasons makes sense. If you have record low interest rates on a long-term fixed mortgage, perhaps it doesn't make sense to pay that mortgage down faster because the money would be better used elsewhere. In this case, we'll take a closer look and decide that, but we do see that there's a $5,000 obligation on these balances between your net and your gross cash flow that you would improve your net cash flow position to once all of these balances are paid off. Now we can see that only $1,900 of that $5,000 difference is going towards your mortgage, which means that $3,000 a month is going to these other non-mortgage related balances, which is quite significant relative to $135,000 owed, which means that depending how you're looking at this, could you take that $135K, invest it elsewhere, and earn returns that outperform what these debts are costing you as far as the net cash flow improvement? And there are other factors that are going to go into that, such as what are the actual interest costs associated with those as well. So we'll glance at that as we go through this. So we get into the revenue and assets page. Got a couple sources of income here. Which one is your side hustle? Is that the CDW account?
Correct.
Okay. And then I see here that credit scores are notated at somewhere in the mid-range. These would be considered somewhere between fair and good. Certainly not serving you as well as they can be and will over time. I see we've got some various retirement accounts and investments that are taking place, along with some cash liquid in the bank to the tune of $10,300. We've got your current mortgage, along with an estimated value of about $450,000. How did you come up with this number?
Basically that's all the mail I keep getting from all the snail mail coming in saying my house is valued at $450,000. I haven't really looked at it.
Okay. All right, great. So there's some equity here, obviously. Might be able to do something with that. We'll take a closer look. So we've got two lines of credit that are currently showing a $37,800 balance. We've got one automobile or installment loan at $6,000 with a $600 minimum payment. So we can see here in this dark shaded column, the target rate on this specific account is 10%. And the way this number is calculated, and this should be fairly easy to digest with this example, $600 divided by the $6,000 owed is 10%. So 10% of your current balance is your minimum payment obligation. This target column indicates exactly what the impact to your net cash flow is based on this minimum payment in relation to what is currently outstanding. So 3.746% is the current $300 minimum payment obligation compared to the $8,000 on this Wells Fargo credit card. So we often will consider that when determining which accounts we want to go after first. As I scroll a little further down past this current $73,000 in credit card balances, I see that we have a $500 Green Sky balance with a $500 minimum payment there. So that's at exactly 100%. That's owed, which means you have one more payment before this is paid to zero, and then this will free up $500 of additional cash flow, driving this number from $4,382 to $4,882. And then that's where we get our grand total of $409,000 $409,207. Now, one fun exercise that I like to do, and maybe some of you will find value in this as well, is I like to take this total of $409,207.45 and divide that by the gross cash flow, which again includes the minimum monthly payments that are being paid to those debts, along with your cash flow position, in order to determine how many months it would take to pay off all of your debt to zero, 100% of it, including your home, if you had no interest associated with those accounts. So if I take $409,207, divide that by $9,342, it would take you just 43 months to pay that to zero if you had no interest. So let's go back and take a look at where your interest costs are, because that should give you at least some hope here that even with the interest costs, when you accelerate the elimination of debt, you pay far less interest over time. In fact, we can see that on the loan calculator page. When we get to this here, we'll take a closer look at how this tool can serve you too. But let's go back to this debts page and just take a closer look. We've got a 6.25% interest rate. Boy, oh boy, that's like an old-fashioned rate, and yet so modern at the same time. Tell me a little bit about this interest rate. When did you open this loan? Was this yesterday or was this 10 years ago?
It was 2 years ago when I was self-employed.
Okay, so you were getting penalized. They were kind of beating you up over the self-employment, had to go with a little less conventional. Okay, got it. And any reason that you decided not to refi that in the last 6 months or so?
My first house I bought was basically this interest rate. I'm sure the interest rate will go down. I'm not so concerned about the interest rate because I can double my payments and triple my payments and pay it off. It doesn't really matter about what the number is. It's the total amount I end up paying is what bothers me more than anything.
Got it. So if you could pay off all your debt in under 4 years, who really cares what the rate is at that point? Simply interesting. Got it.
Bingo.
Okay. So we'll take a closer look at that loan calculator page when we get a chance. I did notice that you'd plugged in this number here of 275, but you have a 6 5/8 interest rate in here. Which one is accurate? Is it 6 1/4 or is it 6 5/8?
6 5/8. That's the accurate.
Okay, got it. Let me just go ahead and change that over here on this side. Okay, so we've got a 5% interest rate on this. This is a PLOC, I assume, personal line of credit through Wells?
Yes, but that's based off of my stock account.
I see. Okay.
Money on that.
Got it. And then we've got a 13.5% on another line. Is this a business line of credit? It says B.
Correct. That is
Got
a
it.
business line of credit.
Okay.
P is personal.
Following you. We've got a 5.64% rate on the automobile. Down here, we've got the Wells Fargo business credit card. Does this report to your personal credit?
That is a business credit card. No, it does not.
Perfect. I see the personal Wells Fargo account, which I'm sure does. I see that you've got this Chase United account here under your Amex. And over on this side where you've diligently put in some detail, you've got a note that says that this is only used for travel expenses and then you're reimbursed for that 100%. So this $14,300 will be paid back by your employer.
Correct. So it's basically a zero. I get expense checks every Friday.
I see. So anytime you get an expense check, do you automatically apply that towards the credit card balance or do you tend to wait until your actual due date?
I just apply it to the credit card balance.
So are you paying down credit card balances throughout the month as the availability is there?
Correct.
Okay. I see that we've got this Green Sky account. Again, this will be one more payment and then you're done?
Correct. That was 0% interest that paid off by the 23rd of October. So that will be paid off by the...
And I see that this tax account that you paid today, from the sounds of it, was paid by your Best Buy account, which I see says 0% interest promotions only. Had to pay the IRS, and that's this balance here, correct?
Correct.
And as far as the 0%, I'm seeing that you're noting a 20% interest rate. Is it currently a 0% promotion?
No, that was the zero. I put the 0% interest promotions over there because if you purchased, I used it to buy refrigerator, washer, dryer, things like that for rental properties and stuff. That's when I get the 0%. It's not going to be 0% for this charge, I wouldn't think.
Got it. So we're obviously paying some exorbitant rates on these non-mortgage related balances, obviously excluding the $14,000 of reimbursed expenses through your employer.
Correct.
But I imagine that if you were able to prevent these costs from slipping through your fingers and going straight into the bank's back pocket, that would be appealing to you too. So looking for ways of potentially doing that. All right, and then if I mosey on over to the personal expenses tab, give my first impressions here. First thing I notice is it does appear that we're dealing with a fairly minimal collection of expenses. This is an unusually low number of expenses, just some items that jump out at me. Obviously, I'm not seeing anything for gasoline. I don't see anything for registration. I don't see anything over here that would be typical for a cash flow cruncher. That generally indicates that it's either A, being paid for with the help from somebody else that you share those expenses with, B, is being paid for by the business and is being tax deducted, or C, it's just incomplete and it hasn't yet been filled in. So which of those, if any, apply to you?
B.
Okay, so that would mean that I'm probably going to find some of those over here on this business expenses tab, which I do see that we got the gasoline. I see that we have the auto registration. So some of these items that we had mentioned here, I also see that you're taking into consideration repairs, which is great. So you're factoring in, you're forecasting, obviously, maintenance on a vehicle, which you need to be doing. It looks like you may pay for some office space. It's covering your cell phone, and that's great. The only other thing that I would sort of take note of is, eating at this point for $200 a month seems a little optimistic given our current inflation. Tell me a little bit about that.
That flows back to my other job. I was at home for only 6 days.
Okay, so this is basically covering you for a week, and the rest of the time is a travel cost, and you're essentially being reimbursed for that, and you're using the business credit card for those expenses.
So I basically have very low expenses. It's all covered by, everybody else.
That's great. That's great. Okay, so I think I have a pretty good handle. Let's go ahead and just take a quick look at this loan calculator page while we were talking about it earlier. I see that we have that $275,000 balance. Now, if you're sitting at that 6 5/8 number, we've got that scheduled monthly payment of $1,760. On your debts page, you had noted that was at $1,900. So the difference between those two would either be your escrows or you were just rounding this number up. Tell me a little bit about how you came up with this payment here.
That's the escrow number that comes up, yes.
So that's principal, interest, taxes, and insurance, which means that on the personal expenses tab, you would not have included that over here. So I see that we don't have the homeowner's insurance or property taxes noted. You did include an HOA due there. Is this a single family home, or what type of property are you in?
Townhouse.
Townhome, got it. So you would not have a lot of additional insurance costs because presumably a lot of those are rolled into the HOA, right? Because it's your, and then, so that the taxes make up the difference on that payment, of course. Let's take a quick gander at where the possible payment would have been if there was a refi, let's say 6 months ago or so. If let's say you were at somewhere closer to 3% better, that payment actually would have come down by almost $500 a month. So not trying to beat you up, but this would have been one of those instances where having another set of eyeballs, had you and I had this conversation back in March, I would have had you run to the bank to refinance that loan from that 6 1/4. And you know how I feel about interest rates. I talk about interest rates being interesting all the time versus being too paranoid about caring about every little 1/4%. But when we're looking at a 3% difference on interest rates, it most definitely can make a pretty significant difference, even with only a $275,000 balance. I say only because had this balance been 2 or 3 times as much, this savings would have been that much more too. So it would have been a lot more painful for you to have a higher rate. Like I said, you're kind of sitting right where everybody else is these days. But
that's 6.625. I couldn't have refied it anyway because I didn't get my job until 6 months ago. So I was not a W-2 employee.
Okay, very good to know. And are you in a similar industry that you've been in? Got it. So how many years have you spent in this type of an industry?
I was 9 years before this in this industry, just working on other pieces of equipment, but still a traveling field service engineer.
I see. And was that consecutive?
Yes. Well, in between that, I became self-employed for about 5 years.
Sure. And was in the same industry though?
Correct.
And was when did you actually acquire the job?
April 15th.
Got it. So you could have beat a couple of those rate hikes, but yeah, who knows where you would have come in at. Regardless, if the rates move, you can be ready to do something about it. In the meantime, if you were to look at paying this thing down early, just because this interest rate tends to be on the higher side and because rates now are going to be similar to this for other buyers, if anyone, for instance, wants to go in and grab one of these lavish properties in Orlando and wants to do short-term rentals, this would be what you're sort of going to be getting, is these more common rates versus the historically low rates. And therefore, any contribution you make, if you were to throw $1,000 in here, hypothetically, as an additional payment towards principal, you can see that it converts into a $7,800 interest prevented total over the course of the term that you have this loan. And you can see that that would shave almost an entire 6 months off of your loan, total of 5 here. So it's pretty impressive what can happen when you're just applying little doses of principal. Now, we obviously teach a variety of ways of accelerating this through additional principal contribution. You can make lump sum payments and then paycheck or cash flow park against the source where you got that lump sum. We do that through tools like home equity lines of credit or unsecured lines of credit. You have obviously access to unsecured lines of credit, both personal and business right now. But you don't yet have a home equity line of credit. That would be one tool that I would definitely be steering you towards fairly early on in your plan of action. The biggest concern I would have on first impression is, of course, something like your current credit scores. Now, these are sourced through Credit Karma, which we all know uses the Vantage credit scoring model, which is not the same scoring model that most banks look at. Most tend to use the FICO credit scoring model. It might be worth investing in a set of credit scores from Fair Isaac's website and getting those directly just to see how they compare to your Credit Karma scores, because you're obviously right on the verge of where most banks want you to be in order to qualify for some of our favorite tools. I generally don't instruct anybody to pursue applying for any type of a tool unless you're at that north of 700 range. Even if they say you can qualify for the tool with less than that, I'm normally going to work on credit first before submitting the application. Try to get those scores above 720. It'll get you better terms. You'll generally get a larger amount. Let's take a quick look while we're here. So we've got a lender that tends to be very popular for home equity lines of credit. This would be a good starting point for folks. I'll also put a link into our in the description below to not just the videos for those lavish keys vacation rental properties that you were mentioning earlier, but also to the debt weapon cheat sheet, which is a phenomenal tool that you can use to shop lenders with and ask the right questions. You always want to know that you have all the information possible before you submit an application, because that's the point that they're going to run your credit. We don't want unnecessary inquiries to show up on credit if it's only going to lead to a declination. If you're not going to get the tool, try to avoid the inquiry. It's not the end of the world if you don't end up approved. Quite honestly, before I was using that debt weapon cheat sheet, my approval rating was somewhere in about the coin flip range. About 1 out of 2 applications I would submit wouldn't be approved. And then once I started using the debt weapon cheat sheet, that number improved to about 2/3. So about 2 out of every 3 applications I submit, I end up being approved for. Now keep in mind, I'm an A-paper borrower. I have no non-mortgage related debts. I have 800 credit scores. I make great money. I have reserves and retirement accounts that show compensating factors. So for all intents and purposes, this is, I should be approved for 100% of the loans I submit an application on, and yet I'm not. What that generally leads me to believe is that a bank like PenFed, who advertises themselves as one of the premier home equity line of credit banks out there, doesn't have unlimited liquidity. And there are times where I would assume they have lent out to their capacity. So even though I might be a qualified borrower, it doesn't mean that I'm going to get the loan. And it also doesn't mean that when they don't have the liquidity to take on new borrowers at any given time, they're going to pull the website down or stop advertising. So that's just an assumption that I make, is that perhaps in those moments where I'm not approved, it's an issue with liquidity through the bank I'm applying for. When I come into this PenFed Credit Union website and I go into the mortgage and home equity drop down, I want to try and gather as much information as I possibly can to fill in the blanks of the debt weapon cheat sheet. So I'm going to try and get as many answers to my questions here. You can see right off the bat that interest rates have gone up quite significantly since the last time we were accessing home equity lines of credit, just a few short months ago. Rates starting now at 9.5%, far cry from the 5% that we were enjoying recently. It gives you a little bit of an education here, it appears. Kind of keep scrolling down their website, see if they can give us any additional knowledge about the specific qualifying factors. It says, how do I get a HELOC? And here's some of the detail I would have been wanting if I were to place a phone call and speak to one of their reps. We've got a minimum credit score of 700 required. Wouldn't you know it, exactly where I told you they would probably end up being. Again, since you're right there on the cusp, probably makes sense for you in this case to pay for your scores through Fair Isaac. I often discourage people from doing that, but the only time I say it makes sense to pay for them and not just simply rely on the free scores, even though they're not always accurate, is when you're right on that qualifying ledge. You may be a little too early for you to move forward on it, but this will tell you for sure where you're, what they're going to be looking at. You need 1 to 2 months worth of pay stubs, at least 1 year of W-2s, at least 12 months of your most recent bank account statements. This automatically jumps out at me as a possible concern. I don't know about you, but that would be something I would need to talk with a banker about, knowing that your W-2 started in April. We don't have 12 months yet. You might be a little ways out from actually successfully applying for a home equity line of credit through Pentagon Federal Credit Union. It may require you to start looking elsewhere. This doesn't mean that all HELOCs have this same underwriting guideline. It just means that you're going to have to shop around. And I would also be on the phone asking this question of somebody before submitting an application. It does say self-employment, you need 2 years worth of tax returns. Given that you're still self-employed, also, I would wonder if maybe they can tie it all together and combine that 5-year history you had before with your existing side hustle self-employment along with your existing W-2 to sort of create a bit of a hybrid for the employment history that they're going to be looking for to become qualified for the tool. Current debts, auto, alimony, credit cards, et cetera. They're going to be verifying all of this, obviously, through credit reports more than any other source in most cases, and then favorable debt to income ratio. So favorable is pretty ambiguous. Usually you're going to want to be somewhere in the 30% range, so between 30 and 40. Closer to 30 is better, and the lower the better in every situation with this. So I'm not really seeing any other major information here. It does give us some of the basics. Probably be worth a phone call, but it seems like you're kind of getting close to where you could be an eligible candidate for that tool. Personally, I think that you may be a little time out. It might be until April before you're going to be for that specific home equity line of credit. It might be that you're shopping it, you find a better one through another lender that gives you the tool today. But in the meantime, what I would probably be doing if this were my set of circumstances personally is look at what the terms might be in order to take some form of distribution in order to drive these credit scores higher very, very quickly. I know oftentimes pulling a distribution from an IRA, as long as that money is replenished within a 60-day timeline, you can use some of those funds potentially. I would be looking at this through the custodian and see whether or not they can give you some information where you might be able to temporarily rely on the liquidity that is available in order to attack and eliminate the balances that are here on your non-mortgage related credit cards. The credit card balances combined with these balances on these lines of credit and whether or not your business line of credit is reporting to your personal credit report would be a factor as well. Anything that's reporting to your personal credit report should have a big red bullseye on it for you right now. At a worst case scenario, let's go ahead and add up some of these numbers. I can add the numbers fairly easily by just taking this $37,812. And is that business line of credit currently reporting to your credit?
No, not that I'm aware of.
Great. So I'm going to take $37,812. I'm going to subtract the $16,326. And that's going to leave us obviously the $21,485. Then I'm going to add to that the total here of your revolving credit card balances, $73,295.35. Okay, so I've got the $73,295 that I've added to that. Now what I'm going to do is go ahead and subtract out the business accounts that are not reporting. So we've got $8,007.71. I've got is that it for a business? Just the one business credit card?
Yeah, one business credit card, one business line of credit.
Got it. And is everything else reporting to credit on this page as far as your non-mortgage related credit card balances. Okay. So we've got a total of a little bit under $87,000 as the total payoff amount. If those balances were paid to zero that are currently reporting to your credit report, what do you think is going to happen to your credit scores?
They're going to shoot up.
Do you have any delinquencies on your credit?
Nope.
Outside of these higher balances? Great. So we know that your credit is currently being punished because of the high utilization ratios that are there. The high utilization ratios, and this will sort of break it down for you. You can kind of see utilizations here on the right.
Mm-hmm.
We've got everything as high as 97% down here, and on the lines of credit up to 93%. That is worth 30% of your credit score, whereas paying your bills on time is only valued at 35% of your credit score. So you're being penalized in almost the same way as you would be if you were to have been late on a payment. It's pretty severe, which means that if we can pull these utilization ratios down and get these balances lower, most definitely you can expect some rapid fire increases. And one of the reasons I like Credit Karma is there's a simulator in there that you can use, and you can go in there and toy around with what that might look like if you were to satisfy some of these balances, just to see what they expect or estimate your new scores could end up being by doing so. And I imagine that you're going to see well above 750 very, very quickly. It would usually be about a 45 to maybe even 60-day reporting cycle on that, but most of it will be captured within the next reporting, which is usually once per month. Once that happens, technically speaking, as long as you had the questions answered related to a home equity line of credit and find yourself eligible for a line of credit, you could get up to 80% combined loan to value on this home. So let's take a quick look at $450,000 times 80% puts you at $360,000 in total availability. You currently have a mortgage on this of $274,141. leaving you $85,859, which, wouldn't you know, comes in very close to that $87,000 number that we just listed as far as your existing non-mortgage related balances reporting to your credit report. So you could hypothetically get access to almost the exact same amount in a home equity line of credit, take that amount from the home equity line of credit, and essentially replenish the IRA that you took the money from originally, right? So if you can temporarily buy yourself a better credit score with the retirement availability, then it might be worth it. I would be going in and understanding the exact terms if you were to access any of that capital, what type of fees might be paid, when it would have to be paid back, et cetera, in order to potentially get that money working for you. Once you do that, again, your net cash flow position improves quite significantly. And keep in mind, I'm also including in this number $14,300 that your company is reimbursing you for anyway. But it will give you a little bit of availability that you could attack this potentially a little sooner so that this number is always coming as close to reporting to zero as possible. So as you're using it, even though it's for work, you can share with them the total amount of expenses that you used for the month. They can reimburse that, but it doesn't mean you have to hold that balance and have it penalize your credit every month. You see what I'm saying? It's unfair to you to have to rack up charges and wait to pay it down for them to reimburse you, and then your credit scores are constantly taking a hit.
Gotcha.
Okay. But we can see by doing that and attacking those accounts, you would end up freeing up obviously this personal account of $500. You would be freeing up this $300 and this $500, so that's $1,300. You'd free up this $300, so you're at $1,600. This payment's going away, so that's $2,100 in improved cash flow. And technically speaking, I think you could accomplish this within a 60 to 90 day period of time. You would then take that $87,000 some odd dollars less the $14,300, but even if I called it the entire amount of the $85,000 HELOC that you get, and you'd make a new minimum payment on that. To give you a little perspective, my current home equity line of credit balance on one of my locks is $225,000. I used it to buy real estate. That minimum payment right now is just north of $1,000 on $225,000. We're talking about $2,100 of new cash flow on just $85,000 worth of a balance. So the new minimum payment on that 85 would be substantially lower than what I'm paying on mine. You could be in the $300 or $400 or $500 range of interest only for that 10-year term, because I believe that's what they're promoting here is a 10-year draw period and a 20-year repayment period, interest-only payments during the 10-year draw period. So your net cash flow position that you would be realizing on that would be a substantially better cash flow situation for yourself that you could then obviously use to cash flow park against the home equity line of credit balance. If your net cash flow position improved by somewhere in that, say, $1,700 range, on top of your $4,300 average net cash flow, some months worse, other months better. If you have a 0 month at your side hustle, this could be a 0 cash flow. If you have a 2x month during your side hustle, this number could be a $9,000 cash flow. On average, if it's $1,700 improved on this, you're sitting at right about $6,000 a month. Well, how long does it take for you to cash flow park against that $85,000 home equity line of credit and pay it to 0, right? So if we were to take 85K, divide it by 6 grand, paid off in right around 14 to 15 months, back to 0, okay? And at that point, you're 100% non-mortgage revolving debt-free. These current balances that are on credit cards now, which by the way, your credit scores you should expect are gonna suffer even further because that hasn't yet taken into account the tax bill, correct, on this Best Buy account. So this hasn't yet hit your credit score. So credit scores are realistically probably going lower before they're going higher, unless you can find resolution in those accounts. But these balances down here are actually already accounted for. This 14,400 and this 3,015 are already accounted for up here, correct? So these are duplicates.
Yep.
It says right over here, paid with credit card, paid with credit card. So obviously this current total debt load is over $17,000 better than what I was using for my calculations in order to show you a 44-month payoff at 0% interest. So that actually would be faster than that. You add in the interest cost, so it's going to be a longer period with costs of interest. But if you could pay everything off within between 4 and 5 year period of time, and you're sitting at a $0 total debt load, that frees up almost $5,000 a month in minimum payments. That drives that cash flow position up to this gross cash flow that we see here, $9,342. This is without anything else changing. This is without you having to go out and buy more property, which I know you want to do. This is without you growing your side hustle to larger numbers, which I'm sure you're working on all the time. If things improve, it would be faster than that. What is your first impression of that type of a timeline between 4 and 5 years?
That's great. That is actually a heck of a lot better than what I was thinking it could be. I definitely something I've got something to strive for now.
Does that make sense as to how we arrived at those numbers?
Oh yeah, definitely. I mean, it's just doing the right math and figuring out where it needs to go in the right time in the right place. And you can completely, I totally I've learned quite a bit from watching your videos on YouTube prior to this and understanding how paycheck parking works and stuff like that. It's a little scary. Like you said in one of your videos, you talked about it. You have to be courageous because you're actually moving money that you're used to paying your bills with and moving it over and hiding it here and making a huge payment and then taking a little bit out of that, and hoping it would work for you. It like you said, it takes courage to do this.
Absolutely. Absolutely. Well, personally, I think there's a ton of opportunity here. As far as Lavish Keys is concerned, I wouldn't have any issue based on what I'm seeing here with you pursuing that. As far as the home equity line of credit contributing favorably towards your ability to do that, there are still question marks. You're going to have to use the debt weapon cheat sheet. Again, I'll put it in the link of the video for everybody to get access to it. I'll go ahead and shoot you a copy of that after we get off of this call, Chris, so that you have one yourself and you can start shopping around for a HELOC that is probably a little more favorable for your employment history. Beyond that, of course, I would definitely take the steps that I suggested related to your credit scores, because those are going to be a factor for you with the home equity line of credit regardless of employment history. But there are some creative lending options with that Lavish Keys business model where I know Jean and those guys are finding deals where it requires little to even in some cases no money out of pocket. One of the videos that I was going to put in the description here talks with with Bobby and Jenny Witten, who just closed on one of those deals because the seller financed the 20% down payment. The first mortgage provider was using the less conventional approach where they're actually basing everything off of the performance of the property. And they are absolutely thrilled with everything that they've seen so far. So check out that video if you guys haven't already. Chris, you've got marching orders on this. Do you have any questions over anything that we've covered so far today?
No, sir, not so far.
Okay. A lot of opportunity here. I see a lot of wiggle room for you. Just go ahead and break out your cash flow crunchers into two separate, one for the business, one for the household. Get to work on seeing whether or not those funds can be put to work for you on your credit card accounts. Get those paid to zero as fast as possible. If you have to do it organically, you got to do it organically. I would much rather see you do this by accelerating it with use of liquid capital. And then I would also, obviously only focus on the accounts that are reporting to your current credit scores. First priority. The interest savings on all those non-mortgage related debts is going to be enormous for you. Enormous at those 20+% interest rates. So you'll get a great return on that investment.
Would it be better to focus on one of those at a time and knock one out, or just pay
Yes.
a lot across each one?
There's different schools of thought. Dave Ramsey's approach, where he snowballs, he always attacks the lowest balance first. He just finds there's more psychological reward that way. Personally, because I like math, I pay attention to the highest interest rate accounts first and attack those. It's considered the avalanche method.
Gotcha.
Yeah. Well, I appreciate you getting on here today with us. Let me know if you have any other follow-up questions for me, but this is very promising, and I think you're certainly heading in a very encouraging direction. And I love the 4 to 5 year timeline. If your main priority is getting 100% debt-free, who could ask for much more than that? So there's a lot to work with here as far as ingredients. It's excellent. Even if you have to wait for a HELOC until April, this is, I don't think it's a big deal.
Right.
There was one HELOC I was working on for 2 years. So you got to understand, these are long-term game plans, folks. Your money will not go away. You will be dealing with your money if you're alive 2 years from now, in 20 years, in 30 years. So I found that patience can serve us well when we're dealing with our money. Just know that it'll always be something we want to strategize.
Definitely.
Well, I appreciate your time today, Chris, and thank you so much for your viewership as well. Guys, if you want a complimentary session with me, just like Chris had here today, go ahead and check the link in the description below. It is first come, first serve. We do have limited availability. But Chris, keep me posted on how everything's going and how your follow-up calls with Lavish are. But very excited for you, my friend.
Thank you.
All right, guys, keep on cash flowing. We'll see you on the next one.